So fractional banking or fractional reserve banking is just when banks take the deposits of people saving their money and then loan most of that money out to other people. And that multiplies the money in the money supply because people save their money and then that money gets loaned out, and then whoever gets that loan also puts that money in a bank, and then that bank loans most of that money out. So the same money gets multiplied in terms of people spending it and thinking that they have it available to them. And more money and more loans means that more people are purchasing things, and that increases aggregate demand. And when we have increased aggregate demand, then we have more jobs because there's more products that are produced, and if there's more jobs, there's more spending. So it helps stimulate the economy. In the 1970s, we had kind of a new situation. After the Great Depression, where the economy was shrinking and they had to figure out a way to stimulate it again. In the 1970s, we had a situation where the economy was shrinking, but we also had rising inflation. Costs were going up. And so there was a real problem because if the government tried to spend more money, it would just make prices rise even more. And people, that was really hurting the economy also. So the normal things that the government wanted to do, like Keynes said, spend money using fiscal policy to stimulate the economy, we're going to make things worse by increasing inflation. And so we needed a different idea to deal with the change that we were facing, or the crisis that we were facing. And Milton Friedman was an economist at the University of Chicago who had some big ideas about free markets, let markets run themselves, and when we run into trouble, use what became to be known as monetarism. By changing the money supply, we could help stimulate the economy in a way that didn't produce, or we could use the money supply to help the economy pull down inflation or increase growth. And he actually studied the Great Depression and saw that one of the big problems in the Great Depression was that the central bank, the Federal Reserve, didn't increase the money supply, so people couldn't increase their spending. And so to combat the crisis in the 1970s, he realized that one of the problems was that the money supply was too great. There was too much money in circulation, and that's why inflation was happening. Prices were rising. And so he suggested that they raise interest rates and try to get the money supply to shrink, and then that would bring prices down. And when the Federal Reserve Bank did that in 1980s, it worked. And so let's talk a little bit about what monetary policy really looks like. So monetary policy is when a central bank changes the money supply to affect aggregate demand. And there are two ways to use monetary policy. You can have expansionary monetary policy, which increases money supply, and contractionary monetary policy, which decreases the money supply. And the Federal Reserve is the central bank of the United States. So the Federal Reserve is the organization that controls monetary policy in the U.S. And its goal is to keep inflation low and unemployment low. So keep the economy growing, but also don't let prices rise too quickly. And they can use the money supply, control of the money supply, to do that. And so the Federal Reserve has the power to create and disappear money. And we'll talk a little bit about how they actually do that. The Federal Reserve is created by the government in 1913, but it's not directly controlled by the government. The government, the President and Congress don't tell the Federal Reserve what to do, how to affect the money supply. They just told the Federal Reserve, here's your job, you go do it. And the Federal Reserve operates pretty independently from the government. And that's on purpose. The tools that the Federal Reserve has there are three. The first one, and the most common one, is open market operations. Open market operations are when the Federal Reserve either buys or sells securities. Open market operations are when the Federal Reserve buys or sells securities. And securities are just loans, usually loans to the federal government. So someone loans money to the government, they get a security in return. It's a piece of paper that says the government will pay you back with interest. And so when the Federal Reserve buys securities, usually from banks, but it can buy it from anyone. When the Federal Reserve buys securities, it spends money, brand new money. It can create money and just give it to the people in exchange for their securities, and that is brand new money in the economy. So when the Federal Reserve buys securities, it creates money and expands the money supply. And when the Federal Reserve sells securities, it takes the money back in and then disappears it. So when it sells the securities that it has, it takes the money out of the economy or shrinks the money supply. And the goal of open market operations are to affect the federal funds rate. And that's the rate that banks charge one another for short-term loans. Because if banks are loaning out all their money and people come to say, hey, I want my money back that I saved in this bank, banks might need loans from other banks just to cover that money until their loans get repaid. And the federal funds rate is the interest rate that banks charge each other. And if there's a lot of money in the economy, then banks will charge each other very little interest because there's a ton of money around, so it doesn't matter if I lend some of it out because there's a ton of it. So if there's a lot of money in the economy, the federal funds rate goes down. And if the money supply is small, if it shrinks, the federal funds rate rises. Banks charge each other more interest on the loans. And the federal funds rate matters to us because most interest rates in the economy, that means your savings account in the bank. It means your credit card rates in the credit card companies. It means your mortgage rates when you take out a loan to buy a house. It means your auto loan rate. It means student loans, educational loans. All of those interest rates are tied to the federal funds rate. So whatever banks lend to each other, that's also what they charge us as consumers when they lend us money. And so that's how the Federal Reserve can help change the interest rates in the entire country. And it's all by putting more money into the economy or taking money out of the economy by buying or selling securities. The other tool they have, one of the other tools they have, is to affect the discount rate. And the discount rate is simply the interest rate that the Federal Reserve charges banks who want to borrow money straight from the Federal Reserve. So if you run a bank and you need a little bit of money because a lot of the people who saved money in your bank want to take their money out, you can go to other banks to borrow from other banks, or you can go right to the Federal Reserve and say, hey, I want to get a loan from the Federal Reserve. How much interest are you going to charge me? And that's the discount rate. So the Federal Reserve can lower the discount rate to make it easy for banks to borrow money from the Federal Reserve. Or the Federal Reserve can raise the interest rate to make it more expensive for banks to borrow money from them. And if the discount rate is low, then banks are going to loan out more money into the economy. And if the discount rate is high, banks are not going to lend out as much money into the economy because if they have to get a loan from the Federal Reserve, it's going to cost them money. The last tool that the Federal Reserve has is the reserve requirements. And remember, the reserve requirement is the amount of money that banks need to keep in their vault. So if they get $100 in deposits, how much of it are they allowed to lend out and how much do they have to keep in the bank? And if the reserve requirement is really low, say they only need to keep 1% in the bank, then if they get $100 deposited, they can lend out 99 bucks. But if the reserve requirement is high, say 20%, then if they get $100 deposited, they can only lend out 80. They have to keep 20 in the bank. So if the reserve requirement is low, more money gets lent out into the economy. And if the reserve requirement is high, less money gets lent out into the economy. These are the three tools that the Federal Reserve uses to control how much money is in the economy. So let's review those three and look at another way to think about it. So open market operations, again, are when the Fed buys or sells securities, loans to the government. And when they buy or sell these securities, they either put more or less money into the economy. So if the Fed buys securities from people and gives them money for it, it puts more money out into the economy. And if the Fed sells securities, then it takes money out of the economy. And this changes the federal funds interest rate, which in turn changes the interest rate for all the loans that happen in the entire country. The discount rate is when the Fed changes the interest rate it charges banks for loans directly from the Federal Reserve. So banks can either borrow more or less money from the Fed depending on what the discount rate is. And that changes the amount of money loaned out. If it's easy and cheap to get money from the Federal Reserve, then banks will loan out more money into the economy. But if it's expensive, if the interest rate is high, banks will probably not lend out as much money. There will be less money in the economy. And the reserve requirement is when the Fed changes the percent of deposits banks need to keep in their vaults. And that makes banks lend either more or less of their deposits into the economy. Because if they have to keep a lot of their deposits on hand, then they can't lend very much out. And if they don't need to keep much of the deposits on hand, then they can lend a lot of money into the economy, which changes the amount of money loaned out into the economy. So those were the three tools that the Federal Reserve uses to control the money supply. That's what monetary policy actually is.